Hi everyone, my name is Simon Misiewicz from Optimise Accountants. I'm going to be starting tonight's session now, all about property investing and your property tax questions. If you do have any property tax questions, or indeed if you have property investment questions, then make sure that you type in your questions in the comments box so that I can answer them this evening. As usual, this session will be broken down to 3 sections. The first section is in the news. So what are the tabloids talking about and how might that be reflective of your own opinion? The second section, I'll be talking about the client FAQs. So these are the type of questions that clients might be asking. And then finally, we'll be opening up Q&A questions to you good self. So if you do have any questions as we go through tonight's session, then make sure you write them in the comments box below, and I will make sure that I get those answers to you as soon as possible. So good evening and welcome all. The date is the Monday, the 27th of May. So we're nearing the end of the month. And it's interesting to see what the press are writing about property investing and property tax. Just out of an insert, if you haven't already done so, make sure that you press the subscribe button and the notification bell icon down below to make sure that you are notified every time that we launch a video. I'll be doing these YouTube lives every Monday at 7 o'clock until circa 8 o'clock, depending on how many questions there are. But we also launch a new video on Thursday evenings on a different topic each week too. So let's just have a look at what's being said in the press. It's some interesting insights, I have to say. The usual doom and gloom about property investing. Interesting enough, I was watching another property investor who's very highly regarded on the YouTube space, especially Samuel Leeds, who talked about buy-to-let property investing, and I could see the amount of frustration that was going through him. When people talked about is buy-to-let dead. Most of the press out there are saying that buy-to-let is dead, in particular around the subject of Section 24, which Samuel Leeds, funny enough, laughed off. I do the same kind of laughing off in many degrees, but not to the level of degree he was. But the press are also citing the changes to non-residents. So if you're a UK property investor, yes, you've got Section 24 mortgage interest relief cap issues. But if you're non-residents, that's where the issues are going to come into full throttle. If you are non-resident and you have purchased a property, not only do you have to pay the things like SDLT surcharge, but you'll also have CGT issues. A couple of things that were going off in the press, funny enough, there's a couple of articles that was at not odds, but they was taking it from 2 different angles. One of them was talking about, I think this is a tabloid, CRS, can't remember the acronym, but CRS, and another one called Property Industry Eye. And CRS was talking about non-residents, and if you're a foreigner investing in the UK, you will now be subject to CGT based on personal CGT rates. So that could be 28% as a high rate taxpayer, as opposed to being able to sell your company and gaining either entrepreneurs relief or indeed corporation tax rates. None of that exists. Okay, so if you're a foreign investor using a limited company structure to buy investments, you will be subject to personal capital gains tax rates, not the corporation tax rate of a company. The other side, so non-residents, so there's pretty much a focus on non-residents this week, it seemed, was the Property Industry Eye that talked about ATED. Interesting enough, HMRC did a report whereby ATED, which stands for annual tax for, annual tax for enveloped dwellings, which basically means that people are buying residential properties inside of a limited company for their own personal use, basically. And foreign investors were using a company structure to invest in the UK, but claiming it's for their own home. So second home, third home, fourth home, whatever you call it. But they was investing rather than in their own name, they was investing inside a limited company to gain some sort of tax advantage. And I think that was around the issue of capital gains tax benefits. So the angle of the press is very much focusing on non-residents at the minute and how HMRC have now turned that around, because HMRC are saying that they've seen an 18% drop of ATED yearly decline on receipts for ATED. So there's a lot less people now investing in their own home inside of a limited company. And even if you're a UK property investor or landlord buying a property which is a 4% versus your own home inside a limited company, could be subject to this ATED rates, which is not something that you want to be embroiled with. Additionally, if you buy a home inside a limited company, don't forget you also lose the primary residency relief as well when you sell the property. So you could be paying a lot more tax inadvertently. And there's obviously this extra SDLT surcharge as well, up to 15% by buying a property inside a limited company if it's closely connected with you. So you do need to be a bit careful about this whole thing. But it was just an interesting insight into how the press would talk about it. Obviously, there's the usual spin of Section 24 being the damning of all buy-to-let property investing. Personally, I still don't think that that there is a great alternative. There's things like banks. Yes, you can get to 1 or 2%. Still not great. Bonds, gilts, pretty much the same. By the way, I'm taking from my own personal perspective. What am I looking at to invest into? I'm investing very much in my business because that's where you most get to return investments. But the passive investments, if you like, I'm still very much focused on property investing. I don't really see any other form of shares or bonds, gilts, whatever else, taking my interest. But it is worth having to speak to a wealth manager. At this point, I should say that I'm not a wealth manager. I'm just looking from my perspective what I'm doing. And albeit there are a number of tax changes, I'm still pretty much keen. I'm still very interested in residential property investing. But I think from taking a balanced view, I think it's always worth you speak to a wealth planner and wealth advisor as well. Now, if you do have any questions, make sure that you do type those into the questions box. I will be kind of responding to you as soon as possible. So what do you think about the state of the property investment markets? Are you still investing? Are you concerned about it? What is concerning you? Type those in the comments box. I'll be really interested to see what you have to say on this subject matter. What else was being said in the press? My Excel sheet is dead for some reason. Oh no, I've been using Word. Hold on. So the CI2, Chartered Institute of Taxation, and the other body, ATT, Association Technical Technicians, have also been suggesting to government to stop tinkering. Enough is enough. You've had a go at the 10% wear and tear allowance. You've obviously had changes in terms of the Section 24, then the SDLT 3% surcharge. You've also had a target at landlords in regards to capital gains tax, which, bearing in mind, capital gains tax, there is this whole issue of decreasing the rates of capital gains tax allowance. If you are a basic rate taxpayer, there is going to move it from 18% down to the 8%, and then from 28% down to the 20%, sorry. And that's not going to happen. If you're a high rate taxpayer, you will still pay the 28%, not the 20% that was reduced for every other type of investor. If you are a residential property investor, they kept the capital gains tax rates to 28%. Furthermore, obviously, we are going to see a number of issues, which is what the press was highlighting again this week, was the fact that capital gains tax rates will also have to take another battering for selling buy-to-let property investments, because there's a reduction from private residency relief from 18 months down. It's going to be whittled down to 9 months. So you could vacate your property for 9 months, for your main home, and you will not be subject to any tax at all. On the 10th month, though, that's where you start to have this impact of capital gains tax, which you're going to have to bear in mind. They also made another change where they talked about the lettings relief. So before, you could have the lettings relief lower of the actual gain or the £40,000 in basic terms. Now, if you had that gain, if you had a property, you vacated that property and then you let it out to a tenant, you could claim this lettings relief. That's all gone from April 2020, a bit like the reduction of private residency relief. Not such a good thing. The lettings relief will also be basically removed, because if you vacated the property and then the tenant moved in, you will no longer be allowed this lettings relief. That's all gone. The only time you can claim lettings relief is if you lived in the property and the tenants lived in the property at the same time. So there's a lot of changes, and what I would always say to people is make sure that you get a tax expert to support you when you're looking at disposing of your property portfolio. So that's pretty much what was coming out of the press, and I just thought there was a couple of interesting insights of how what I find really contradictory and frustrating is the fact that you have the government saying they do not want landlords, and at the same time they're saying, well, but we want to tax you at the highest rate for capital gains tax, and we're not going to give you any incentives. This just shows you the state of our country right now and how messed up it is. And I think that the fact that George Osborne is gone, yes, it's great, but then you've got Hammond that's potentially go for the leader of this country. I mean, God only knows where we're going to end up if he gets in. But I'm not going to go into too much of a political view. But I just beggars belief in terms of what this government is trying to do. We clearly have homelessness going on, and yet we're still penalising the landlords as it is. My view is that there is a lot of upsides using limited companies. And interesting enough, in section 2, we'll talk about what clients are asking for. Clients are very much the flip side to the press. Obviously, that's what the press has been talking about. No, buy-to-let is dead and various other things. Our clients are talking about investing in limited companies, which mitigates Section 24 altogether. It also allows them to do share structures to make sure they can extract money from their limited company when they need it. The beauty of holding a limited company, I'll go into a bit more detail later on, is the fact that you're only taxed personally on the money that you extract out of the limited company. Yes, you have corporation tax, but that's much lower than personal tax as high rate taxpayers. So you are benefiting from using a limited company structure in a way, more so than I thought before. One of the things that came out in the press, I'm just going to get the reference to this. This is the FT, funny enough. So they talked about build to rent, which there's a number of big organizations now getting involved in build to rent. Legal & General, for instance, have got 11 build to rent schemes going on right now, whereby they build and instead of selling, they are renting out, and the government are incentivizing them to do this. And obviously there's a big development around this whole thing. Build to rent was something I heard about maybe 4 years ago. It's a networking event, and now it's pretty much sweeping the nation through different organizations, big organizations, I have to say, rather than the individual investors and property developers. However, the FT had an insight to this, whereby they're saying that people that are renting in property are paying a premium for these build-to-rent products. The FT was citing to say that people are paying 11% premium over and above what they might pay elsewhere. So as in a property that you and I might be letting out to them. But the other knock-on effect is that the age of renters is now increasing. So there's this whole issue of retirement, because you and I as property investors are buying properties and it's given us capital, and eventually we should have a retirement pot because these properties are worth more than what we purchased them for. However, if we have an aging population that is going to be retiring and they don't have a home of their own, they can't even downsize, which releases cash. So the FT it was an interesting article, to say the least, to say that the build to rent could have a negative knock-on effect, again introduced by the government. So the government is saying, on one hand, they want to get rid of amateur landlords because they want to create homes for people, and yet on the other side of things, they're saying, yes, legal in general, and various other insurance companies and big developers, yes, please make sure that you do these build to rent because we want to encourage it. I mean, which side are they on? I mean, yet again, it's a mockery of our government in terms of not understanding how we communicate and how we listen to our own speeches in the House of Lords. It's total contradiction, and it's a total shame that this is happening. Whereby, from my personal view, I think they're targeting smaller property investors and developers and going for more corporate kind of structure. And I can appreciate that from I want to professionalize the industry, but they can do that by a lot more incentives to remove rogue landlords, which I think they're doing some work on, but not enough. But anyway, that's my rant. Apologies for that. But the whole point of what I'm saying here is that the FT is an interesting side of things into saying, well, there could be a knock-on effect of this build to rent rather than build to sell, and incentivize people to buy those properties, which is what the government really wants to do in the first place. I think it's this week, also sent another article out saying, is buy-to-let dead, ? And they talked about, should be investing in ISAs and pension. From my perspective, I think you should always have a balanced investment pot anyway. I know I do, where I want to make sure that I look at different areas of investing money. So if one goes down, such as property, I've got another kind of pot to play around with. So I always think that you should get yourself a good wealth manager to talk about your long-term goals and how you might want to invest your money. That is definitely something I should say. But is buy-to-let dead? I think it's a ridiculous comment to make, and anyone that's writing that does not understand property investing at all. I think they just see it from their side, and they're jumping on the bandwagon, as most people do. Hooray, let's join on and say the same old thing that everyone else is saying, so that we don't look at it from a different perspective. And I always bring it back to Warren Buffett, who said, when people grow greedy, you grow fearful. But now on the flip side, when people are growing fearful, which is what everyone else is doing right now, you should be greedy. You should be investing in property. You should be looking at some of the ways that you should invest in property more wisely, using company structures, different types of property, whether that's commercial or whether that's mixed use, to reduce the stamp duty land tax, which I had a video about this subject of reducing the 3% SDLT surcharge. All these tax changes that I'm seeing coming in trying to attack us as landlords may be mitigated, totally mitigated. So you just need to look back at some of our videos on our channel to find out how SDLT, CGT, IHT may be minimized, and going almost back to the day before these changes even existed. So there are different ways of investing. You can invest more wisely. Yes, it's removing the amateur, but you as a professional have the knowledge, have the time now to suitably plan your investments to reduce your tax liabilities on all fronts. It's not just about income tax, because of Section 24, the whole thing about SDLT and CGT may be mitigated in full. So that's pretty much what was in the press. It was an interesting read this week, I have to say. It wasn't as doom and gloom as it's been in recent times, but it's still pretty much saying buy-to-let is dead. It's clearly a good SEO term right now. So if you're an article writer, putting buy-to-let is dead and maybe changing a few words here, there and everywhere, you may do really well, because that's clearly a fad right now. So have these changes affected you? What's your perspective now on investing? Write your comments in the question box now, please, and then let me know what's going on. What are your thoughts in the world of property investing? So should say hi guys on my notes. Let's see if this works. So yes, what I was going to say is let's have a look at what clients have been asking for, which is a total flip side as usual, which I'm not surprised about at all from what the press is saying. So one of the clients will talk about limited companies. In fact, most of their questions I saw which is interesting, was the use of limited companies. And you might have heard me already say, if you use a limited company, which is taxed at 19%, 100% of the mortgage interest costs will be allowed against your property income. So that's number one benefit. The second benefit is that corporation tax rate is 19%, but next year it's going to drop to it's going to drop to 17%. So from April 2020, corporation tax will be dropping to 17%. Benefit number two. That's because 17% is less than you as a basic rate taxpayer of 20% in your personal name. Third is the fact that you can extract money out of a limited company tax-free for dividends, and you only are penalized from an income tax perspective when you extract money out of your company. Benefit number three. You can also look at the way you structure your shares. So you can incorporate IHT proof, if you like, share structures to minimize that kind of impact. When you pass on, you are taxed at 40% IHT. Everyone has a lifetime allowance of 325,000. Once you go over that amount into the net asset, you could be subject to IHT of 40%. Or you could use share structures, use growth shares or what they might call freezer shares to minimize the impact of that. You can also pass shares on to loved ones to make sure that they have some sort of income as well. And that really works when you have non-dependent family members. So if you've got son and daughter who have gone off and wanted to kind of start their career and they needed a helping hand, you could give them shares in your company and those dividends could be paid to them. You don't need to be taking money out of the company. You've been taxed at the highest rate and then passing that money on. You could change the way you structure. And interestingly enough, people have been asking questions about, well, how do I change my share structures accordingly? Well, you need to speak to a tax advisor, clearly, because there's things about you as an individual. You've got your spouse, potentially, or civil partner, and how do your share structures work? You've also got children. You may also have joint venture partners. And one interesting conversation came out whereby one particular client thought that they had an agreement between these two. So one person had 100% of the shares of the company. This person came on board and said, well, okay, let's do this properly. Let's split the shares accordingly, 50-50 or something like that. And yeah, we'll do business. One thing I would always say is make sure you look at the fine print, because in this example, unfortunately, the existing or the previous owner of this business had agreed to do the share structure change, but they only did a confirmation statement. A confirmation statement is what you tell Companies House each year, who the directors are, who the shareholders are, and you send this form each year. But what they failed to do is complete the right share certificate forms, which allows then to Companies House to be aware that these shares had been transferred over to our clients. So our client is potentially really at risk here because these share certificates were not issued, and share certificates were not issued, and as a result of that, could be leaving exposure to say, well, you don't own any part of this company at all. So make sure that you look at the fine print in everything that you do with regards to legal documentation. Make sure you get a legal advisor to support you with this kind of thing. I think that's really, really key. The other thing that our clients were talking about as well is, can you loan money from and to your own limited company? Or indeed, if you have one limited company over here, can you loan money to this other limited company? And the reason why this might happen, by the way, is you may have one service business, which is mainly bread and butter, and it generates cash and it has cash that sits you in there. And can you loan that to your property investment company to buy properties? And the answer is yes, you can. And we'll cover each one of those triangular points at a time. Let's imagine that you are an individual right now, and you're a full-time employer, and you've got all this employment income coming into your name. And you start up this limited company, and it's got not a penny inside it at all. What will happen is that you might find a property that's worth £100,000, to keep the maths really simple here, and you might get a mortgage through the company structure for, let's say, 75%, so £75,000. Now, where does the other £25,000 come from for the property? Because you've only got £75,000 for the property in question. Well, it's clear that you are, as an individual, going to have to invest £25,000 into that limited company. And that will be then a direct loan, which the company owes you that money. You can then take that money out tax-free whenever this limited company now has money coming into it. So if the property is refinanced, or if it's been rented out and it's got good profits, it can then pay you back this £25,000 loan, and there would not be any tax or income tax issues for you. Now, one or two clients have, funny enough, said, well, I would like to charge my limited company for this £25,000 loan example here interest. And well, that's fine, but there's a couple of things that we need to bear in mind here. If you've got £25,000 and you've got £2,000 worth of interest, well, what's going to happen is that your limited company is paying out an individual interest. And because of that, HMRC have said that the company in question must complete a CT61. That doesn't mean anything to you, and I appreciate that. But it does mean that HMRC have demanded that your limited company now files quarterly returns to say, well, how much interest has been paid out to individuals. Furthermore, you have to deduct income tax from them as well at 20%. So if you're expecting £1,000 worth of interest to be paid to you from your limited company, well, you're going to be disappointed, because the limited company has had to retain £200 and pay that over to HMRC because it's paying you interest. And this kind of makes me think, well, what's the point? Because the money's coming to you in the form of interest. The company is saving right now 19%, but you are being taxed at 20%. So you're not saving any tax at all. And especially if you're going to be putting the money back in again for the company to invest. It gets worse, because if you're a high rate taxpayer, you have this £1,000 worth of interest that should have been paid to you, but it wasn't. You have this £800 worth of interest now paid to you, but you've now got an extra 20% tax to pay on in your self-assessment. So, has it really been worth it? And I would have to question, well, not really. I would rather see people loan money to your limited company, leave it in there as a nest egg, a pension nest egg, for it to grow, and for that limited company to buy more and more properties. So yes, you can charge yourself interest. Sorry, you can charge your limited company interest, but do I think it's worth it? No, I do not think so. And by the way, hopefully you're finding this useful. I've not seen any questions. So, I did have my first question of the night has come in. So I'm going to come to you for that. So thank you, Bavert, for that. I'll come straight to you about section 24 in a short while. I do need to go to my, I do have a question coming through as well. Wayne Wright asked a question, so I'll need to come back to that as well. Just noticed Wayne is on my webinar chat. So good evening to you, Wayne. Please go to the YouTube live going forwards, because I may not see the question bank coming from the web chat going forward. So apologies for that, but I might not be able to see it. So yes, let's go to Purvis' question. So Purvis asked a question. Section 24 is applicable only if your income is below £45,000. Ooh, I wish that was the truth. Let's imagine that you have a property right now, and you are at £45,000, which you're quite rightly saying you wouldn't be subject to any more tax. However, if you're at £45,000, you've got a property that generates you £12,000 worth of mortgage, and you have £12,000 worth of mortgage interest. Sorry, £12,000 worth of rental income, and £12,000 worth of mortgage interest. In 1617, that is pretty much going to be netted to zero, as in there's no tax to pay because the interest equals the rent. Okay, simple as so far. However, let's go back. Well, let's go forward now. Back. My words are scrambled. It's like my brain's been fried in microwave. Let's go forward to 2021, when Section 24 comes into full effect. Now we're looking at a situation whereby you've still got the rental income of £12,000, but now the mortgage interest won't be allowed. So if you've got £45,000, your taxable income is going to be increasing to £12,000 because you're not allowed the mortgage interest. So now you have got this extra tax at 40% on that 12,000. Yes, you get a 20% tax reducer on mortgage interest, but hopefully you can now see how the tax changes. It's going to say, even as a basic rate taxpayer, our calculations would dictate that you're now a high rate taxpayer, even though you're not really. It's a paper exercise, and that is what you have to be watching out for. So it's a great question, Bella. Unfortunately, I do have to say that we're going to have an issue with the way things are calculated. So great question. It's just unfortunate that your calculation means you will be a higher taxpayer, even if you're a basic rate taxpayer. So make sure you get advice on that. What we do for our clients is when we do a self-assessment tax return, we will forecast for the next 4 years what impact Section 24 will have, because we want our clients to be very much aware of these tax changes and how it's going to affect them in advance. We want them to be as proactive as possible in terms of disposing of properties, investing in limited companies going forwards, maybe looking at incorporating their property portfolio if that's applicable to them, maybe selling some properties on, maybe paying down some mortgages. I've just given you a list of things that you can do to save yourself from Section 24, just like that. So hopefully that's been useful for you. And write down in the comments box, has Section 24, have you seen a change to the amount of tax that you're having to pay? If you have, type in yes, and don't tell me the specific number, but just tell me how much more tax you've had to pay because of Section 24. Please type that into the comments box just below this video, and then that will help me understand whether you are paying more tax. If not, then that's fine, that's good. Type in no, it hasn't affected me, and then I'll be celebrating your success. Wayne on the webinar is asked a question, I'm working via my limited company as an IT professional, and this is linking very nicely, Wayne, so thank you very much for this, to the other point I was going to make just shortly afterwards, and plan to set up a limited company for the purpose of buying property with a long-term investment view. Now, did you hear me what I said earlier, Wayne, whereby you could have your own limited company, which is exactly your thing, which is cash rich, and you want to invest money inside another limited company to buy investment properties. So this is pretty much your kind of example, and I was going to come onto it just perfectly timed. Question, how should I fund the SPV via my limited company in most tax efficient manner to all entities? My view is that you would take your limited company, which is the one that's cash rich, you would use, let's say, £25,000. As we did in the previous example, you've got £100,000 property, £75,000 worth of mortgage interest, and then that leaves you £25,000 left to fund. You would take that from this limited company over here, bring it over, and interestingly enough, this one could pay interest of 3% as an arm's length transaction. And there would not be the same CT61 issue that you would face as an individual charging interest to that limited company. So from a tax efficiency point of view, you can loan from one company to another, and it can be paying it back, and there'll be no impacts of tax at all. This company, the investment company, can pay interest, as I mentioned, arm's length transaction and all that, and there would not be any tax liabilities because ultimately one has a tax reduction for the interest that's paid out, and one would be taxed on the interest that it's benefited from. So there's no nil kind of tax effect, but it is getting money back to this main company. Please note the difference between you as an individual would have to pay income tax on that tax, and it could well be more than the tax saving you're getting from a company. So it's a great question, Wayne, because that's exactly what we're facing with a number of investors. And that brings me nicely onto that point. So thank you ever so much for that. The other side to it, and I want to talk about, we talked about limited companies, and funny enough, a couple of questions that came up from our clients whereby they've invested this £25,000. And let's imagine that over time, that limited company's refinanced its properties, it's done some real good results over the years, and it's now got £30,000. It paid you back this £25,000, but it also pays, it also pays you this extra £5,000, which is now considered to be an overdrawn loan account, because originally you had £25,000, which the company owed. It has paid you back that £25,000, but it's paid you this extra £5,000 as well. And you've not taken that as a form of wages. You've not taken that as a form of dividends. You've just taken the money out of the company. There's the problem. There is the problem. Because if you are owing the company money, then there is a tax charge of 32.5% corporation tax, which is pretty much the equivalent to the tax rate that you would have to pay as a high rate taxpayer. The company could get that money back, provided it gets the £5,000 back from you. So if you've got this overdrawn loan account after your year end, you could be faced with this 32.5% tax rate, even though the company's not made any profit. It would still have to pay tax on this £5,000 is given to you in a form of a loan. Okay, so you've got this tax charge now, and what you're going to have to do is pay it back as quickly as possible so that you don't have this corporation tax burden, or you can ask HMRC for that money back if the company's paid it. My view is don't get into that situation. If you are going to be taking money out of the company because you need it for lifestyle purposes, you need to find a way to take money out of your limited company in a tax efficient manner. So do bear that in mind. Make sure you get tax advice on that bit. Don't just take money out of a company without really knowing how much money you was owed in the first place and how much you subsequently then took out. It's easy to get trapped because what you might end up doing is spending that money and not even have the money to pay the company back, and now it's got a 32.5% tax charge because of it, and there's no avoiding it, unfortunately. So yes, in terms of, let me just go to any questions on that point. Have you got any overdrawn loan accounts? Does your company owe you money? And if so, have you charged it interest? Are you thinking about charging interest to your own limited company? Have you got another limited company like Wayne has with his contracting business, where it's investing inside of this property investment business? If so, maybe just type in a few questions relating to that, just to say, well, this is what I've been doing. Does it seem right? You may as well get your answers tonight rather than not at all. So feel free to ask me those questions if you're using this kind of structure, and I'll get back to you. Wayne, hopefully I've answered that question. So I'm going to just remove that now, Wayne. So let me just do that. Good. So I'm just going onto my, there's a couple of question panels that's now appeared. So I'll have to make sure I get onto the right one. Okay, so let's have a look. So no other questions. So, well, okay, guys. Well, if you do have questions, please feel free. This is your Q&A. This is your time. I'm doing this because I really want to help you out, not just property tax, but property investing as well, in terms of the type of property investing that you might be doing. I recently, just on a side note, just to stir some emotions, to stir some encouragement for you to get on this Q&A. I did talk about my previous video about mitigating the impact of 3% SDLT surcharge. The 3% SDLT surcharge came into play for residential properties, where if you've got a property that you already own, as in a home, and you buy another property, you will be subject to 3% SDLT surcharge. If you are buying a residential property inside of a limited company, you again will be subject to this 3% SDLT surcharge. And I talked, funny enough, in the previous video we launched maybe a week, 2 weeks ago now, we talked in that video about buying mixed properties. So you've got a shop below and then a flat above. And because of that, it's called a mixed use property, non-residential rates. 3% SDLT surcharge does not apply. albeit I have seen one solicitor get this completely wrapped around their necks, whereby they try to charge the 3% SDLT surcharge on the residential flats above the shop. Crazy. It happens. Make sure you check your solicitors, what they're doing, because you inadvertently could be charged more SDLT than you should be. But not going on the rant, have you thought about investing in types of property? Are you thinking about investing in property in the future? And I think that's going to be in terms of the different types of investments, that is. So commercial properties, flats that are above a shop or a restaurant or shopping malls or anything like that. Are you thinking about doing that? And if so, type in the comments box below to share with me what you're thinking about because of Section 24 and the 3% SDLT surcharge. You're pretty quiet, I have to say, but I'm hoping, 9 of you are watching. I'm really pleased that you're sticking with me. Hopefully you find this useful. But please do type in your questions. I think if you're on your mobile, I think it's quite difficult, actually, I have to say, but we'll get there. But maybe if you can type in or press like on the video at least to know, let me know that this is useful. That'd be good. Some feedback is better than no feedback after all, and I would truly appreciate that. One other thing that came out, I'm just reading my other tax notes from my clients, was joint venture partners. I talked about joint ventures. One thing that you can think about is making sure if you own a company or they own a company, one, making sure that the share certificates and transfer forms have been done correctly. But the other side to it is, well, if you don't want to be financially tied, maybe instead of having shares of a company that you each have, one of the things you could do, and it's something I advised with a client previously, is that you have the limited company 100% owned by you, and you have a separate contract that's in place to say, we will share the profits of this property between us. So what would happen is that the property income would come into the company, the expenses would also go out of the company, and your JV has a contract with you that says, I will charge you 50% of the profits. So that would then come in as a management consultancy charge, whatever, and they would invoice you for that charge. They would get their money, but they're not being financially tied to you, which they would be if there was a shareholder. So it's different ways in terms of structuring your limited company before you go into that. And the reason why I suggest it that way is because you may have 5 JVs all in one company in this regard, and you could have then 5 contracts that's between your limited company and them as individuals or their company. And the reason for that, that's going to be an interesting factor, is that you don't then need 5 limited companies, 1 for each JV partner. So it may be saving away in terms of administration, accountancy costs and all that baloney. So do think wisely about the structure that you're going to be using for your limited company, especially when it comes to your joint venture partners. And that's pretty much it. And hopefully I've been answering questions as you're going along. Do you have any questions? Now, this is your time. I've got 10, 15 minutes to answer your questions if you have them. I saw a question just come in. So, hi, Simon. Yoko's off screen. But the commercial properties do have SDLT, though, even if the mixed-use property, don't we have to pay SDLT? Yoko, sorry, that's my apologies for that. What I meant to say is that commercial properties have non-residential rates of SDLT, which are cheaper than residential rates, which is in my previous video, so do make sure you look at that video. But it does not have the 3% SDLT surcharge. So it has the standard bracketed SDLT charge, but not the extra 3% SDLT charge that goes with it, as you do with residential properties. So hopefully I've answered that question, Yoko, to your satisfaction and a bit more clear. Oh, great. Fantastic. This is more interaction. I'm so pleased. So Gregory's asked the question, will a loan to a property company affect any future entrepreneur's relief claim in a company loaning the money? Gregory, this is a brilliant question, and something that I've been saying to some clients for a long time. Be careful. Let's imagine that this company, which is a service-based business, it has £100,000 worth of deals that go through it. So you might be an IT contractor, you might be a business contractor, business consultants contractor, and it's got £100,000. And at the end of that term of that contract, you might say, well, I've done my bit, I've had enough, let's close the business down. And as Gregory mentioned, you get this thing called entrepreneur's relief, which basically means you've got this £100,000 worth of money still left in the company, and now you as an individual take this £100,000 back. When it comes to your tax return, you would do a capital gains tax disposal to HMRC to inform them of the sale of your business. And you would apply the entrepreneur's relief tax, which is ignoring capital gains tax annual allowances here. But let's imagine you've used those up and you've got this £100,000 worth of money coming in. You would have a capital gains tax liability of 10%, which is £10,000, which is what Gregory's talking about. If, however, that you've now got this £100,000 and what you've been doing over the years is investing that into another investment company, that £100,000 loan from this company to this company is now treated as an investment. Well, that's the issue, because this money may be paid back to this company, which is then closed down, but HMRC will see this company no longer as a trade or a business. They will see it as an investment, and you would lose entrepreneur's relief, which is what Gregory is alluding to. Absolutely right, Gregory. That is going to be a major, major issue. So this whole thing of entrepreneur's relief may be lost. You are now going to be taxed at 20% tax because that's the rate of limited company disposals. So that's 10% more tax than you would have anyway. Now, is that a main concern? Because when I've been talking to clients, what I've been hearing is that they've got this investment, this trade, this management consultancy business. And what's been happening is that they've got this sum of money and they've been leaving in bank accounts. And it's just been accruing a bit of interest here, there, and everywhere. Well, the problem is with that, Gregory, is even if it's in a limited company bank account of its own, that money's still being regarded as interest, as an investment, because it's not using it for business trade activities. You're not reinvesting it inside of your company. And as such, HMRC could turn around and look at this business and this disposal, the closing down the company, and say, we don't believe it's a trade because you've got more activity going on now with your investment. Okay, so the money that's been lent into a bank account or shares or whatever you've done, and that may be triggering an investigation to say, well, we don't believe it's now a trade. We believe it's an investment company because it's invested into a bank account. So, you know, there is this whole connotation. I do also believe that entrepreneur's relief is under threat because of Brexit. I think once the whole Brexit, whether we do exit or not, comes to full circle, could entrepreneur's relief be subject to scrutiny and therefore closure? I do think it could be at some point in the future. I don't think HMRC have been a total fan of it. So I think you just need to be aware of that as well. But great questions, Gregory. I'm glad that came out. Perverse asked a question, is your next webinar, can you talk more in detail about SDLT, various exceptions, such as multiple dwellings relief and linked transactions? Perv, you've got a specific question. I'll be more than happy to take that anytime. So if you've got a question that you really want to get through this evening and you've got a specific example, please do write that down and I can work through a solution for you on this call, hopefully. But equally, if you don't have the time to get that to me on the comments box tonight, I will promise you that if you do it next week, I will make sure that I give you the answer. I can't say further than that. So yeah, over to you. You supply the details on the comments box and I will try my best to talk about MDR or multiple dwellings relief for SDLT purposes and go through that. Will MDR apply to commercially or mixed use property? Well, multiple dwellings relief applies to all. So it's not just to residential. I think that there's different types of way of looking at MDR and which rates you should use. You've got obviously got the averaging rates. You've also got the whole purpose of non-residential rates anyway. So let's get, for an example here, if you buy residential properties and you buy a portfolio of 6 properties, then it automatically goes to non-residential rates anyway. So you don't have to pay the 3% SDLT surcharge, for instance. But feel free to kind of bring that question to me for the next time around, and I will get those answers to you. Let me just see if there's any other questions that are coming through. I've just lost my, you're welcome, Pervert. And please do make sure that, by the way, if I'm hoping I've said your name correctly, by the way. I haven't got my glasses on, my screen's really small. So I've not done myself any favors here tonight. No other questions come through. So I think that's pretty much it for tonight. So thank you ever so much for joining me this evening. Hopefully you've found this useful. Please make sure you press the subscribe button and the like button as well. If you like this session tonight, please type in why you've liked it, what did you benefit from it. Press the like button, press the subscribe button, press the notification button, and make sure that you know, I'm aware that this is helping you. If you get to a stage whereby you think, oh, I've got a great video, but I still didn't get the answer to my question, feel free to type that into the comments box, because what I will do, and Peva, maybe you want to do the same thing. If you type it to the comments box, I will make sure I answer it within 24, 36 hours. So even though I'm not live, I still might be able to provide you with an answer that you deserve. So feel free to do that. And in the meantime, thank you ever so much for joining me this evening. I appreciate it. It's a bank holiday Monday, but it's great to see so many people that have joined me tonight. And I do appreciate that. And hopefully you found this useful. In the meantime, enjoy the rest of your bank holiday Monday. Have fun if you're working tomorrow as much as you can. If you're on holiday, you lucky ones, hopefully you enjoy it with the family, and hopefully I'll get to see you next Monday as well. Thank you ever so much, guys, and see you soon.